Hello and welcome. You're tuned into CNBC-TV18 Prime. Let's get cracking on a brand new edition of The Big C. I'm Manisha Gupta and with me is Nigel Dsouza. Your dose on commodities, cryptos and currencies is what bring you. But what are we focusing on today, Nigel?
Well, plenty, right? And we'll also turn the spotlight on the currency space and take stock of that unprecedented decline that we're seeing in the dollar index this year, marking the greenback's steepest decline all the way since 1986.
Well, yes, it's a 9% decline in the first half of this year. So this is the worst first half that we are seeing since 1986. But the markets also have stripped out mostly because of the geopolitical risk premium built in case of crude oil prices following the Iran-Israel ceasefire and with possibility of the OPEC plus potentially heading for a fifth monthly output hike. Well, understand the directionality for the prices. All this and lots more is lined up over the next half an hour with Khoon of ANZ Research and Premasish of S&P Global Commodity Insights.
Well, a quick revision of what's going on in the equity markets. Wall Street is set to capture gains for the month. The S&P 500 has scaled a fresh peak in over 4 months. Now, the up move in the month of June is largely aided by the exuberance in the investor community over the fact that most of Trump's dire tariff threats have not been implemented. Well, for the month itself, they're sitting on hefty gains. The S&P 500 is up 4.4%. The tech-heavy Nasdaq is up closer on 6.1%, while the Dow has added closer on 3.7% month to date. Even stock futures are indicating a start well in the green. Remember, in Friday's trading session, the S&P 500 was back at record highs. And it's a similar story that's unfolding in Asia Pacific as well. Investors continue to pause details from the ongoing trade negotiations. The street also seems to be digesting a slew of macro cues across Asia. The Japanese Nikkei, well, it shut shop well in the green. Meanwhile, the Chinese Shanghai seems to be on a similar footing. This as the street kept a close eye on the Chinese manufacturing activity, which contracted for the third consecutive month in the month of June. That's fueling hopes for more stimulus to cushion the impact of the ongoing trade disruptions between the superpower and the United States. Well, back home on the Wall Street, though, the markets are trading with a bit of a negative bias. With they're starting the week. The Nifty, though, is holding above the 25,500. Though at last count, we were down closer around 100 points on the Nifty. But Manisha, the big story is the dollar index, and you can't take your eye off the kind of slide we've seen in the dollar index. Tell us more.
Oh, well, absolutely. Nigel, we started this year at 110 or plus kind of levels. And look at where we are trading right now. The greenback has mirrored its worst slump since the 1980s. Not just that, it also has the worst first half for the dollar index amid flaring concerns over growth and credit policy in the United States. It could be a story of two halves for the currency. The once mighty dollar has plunged a whopping 10% this year, one of the sharpest falls in modern history. Taking cues from macros, consumer spending in the U.S. unexpectedly fell in the month of May. Street also continues to track those dovish comments that we heard from the U.S. Fed Chair Powell last week. The Fed rate cuts would reduce the interest rates, advantage of the dollar relative to peers. The traders are now pricing in a 65 basis points of cuts by this end of year, up from 46 basis points just a week ago. The story for crude, too, is looking sombre. It has seen prices now witnessing a 13% downtick in the last 1 week itself. All eyes now perched on the OPEC plus and a fifth potential output hike estimated. The prices in fact, have also notched the worst weekly decline in 2 years that we've seen come in for the crude oil prices. Well, on that note, let's take the discussion forward with Khoon, Head Asia Research, ANZ. Khoon, thank you so much for joining into the dollar index first. And as we close the first half of 2025, the big headline clearly seems to be coming in from the dollar index. The kind of sell-off that we have seen, would you say we are done for the year? Or with the kind of background that we have and statements and tariff concerns, is the dollar headed further lower?
Well, we're definitely not done. We expect further dollar weakness, and indeed, we remain very bearish on the US dollar. We're expecting the DXY to continue to fall towards 95 by the end of the year, and further towards 91, 92 by the end of next year. And it's really two main reasons. One, from the US economic side, it's very clear given all the unprecedented uncertainty around US policy making. that global investors who had been overweight US financial assets over the last few years are looking to trim their dollar exposure. So despite US equities doing very well, heading towards all-time highs, I think foreign investors are looking to take advantage of that to trim their exposure, hence the weakness in the dollar. So if you like, this is what is commonly termed as an unwinding of that US exceptionalism theme that has been apparent for the last few years. But it's not all coming from the dollar side. I think most of the beneficiary of the dollar weakness has been the euro, which has now rallied past 117, and we think is on track towards 120. And here there is some euro-specific factors at play. I think the sea change has been the willingness not only of Germany, but many parts of Europe and particularly the NATO countries to increase their defense spending and overall fiscal policy. And this will provide a boost to economic activity in Europe. In addition to that, the ECB has been very clear that they are getting close to the end of their easing cycle. So maybe we can expect 1 to 2 more cuts from the ECB before they pause. And herein, the Fed, on the other hand, has a lot more work to do. We think they'll begin their renewed easing cycle from September. And as you mentioned, the market is already anticipating cuts of 2 to 3 by the end of the year and potentially more into next year.
All right. Hi, Khoon. Good to see you. Interesting point you're making out there. The dollar index is set for more unwinding, 95 in the near term, and by next year, maybe we'll be at around 91. But all eyes are on, the Fed, as you mentioned. The street of just looking at the Fed futures last time around, they're indicating close to around 3 cuts for this year. Do you think we'll get 3, or do you think they'll fall short of that?
Look, our forecast is for 2 cuts. One in September and the other one in December. Will they do more than 2? Quite possibly. It all depends on the inflation data and whether or not the tariffs will have any meaningful impact on near-term inflation. So whether it's 2 or 3, I think in the grand scheme of things, it's probably not that material. I think the important thing is as long as the Fed commits towards further easing, particularly into 2026, I think that will continue to put the dollar under pressure.
And in 2026, we'll all likelihood have a new Fed chair as well. President Trump has been pushing that point, so we'll have to see how that goes.
I would put that question to Khoon as well. Khoon, do you see that happen?
Well, there's no doubt there's going to be a change in the Fed chair. Powell's term expires in May 2026. And all indications are that he will be replaced. So the only question is by who? So the commentary is that President Trump is going to appoint his next successor in the coming months. That person, if named early, will therefore become sort of like the shadow Fed chair. And no doubt President Trump will want to appoint someone who is more dovish and willing to take rates lower.
That point is well taken, Khoon. I also want to understand on how do you see the global Forex trade at this point? I mean, as we've been talking on how the dollar index has seen a very sharp decline, euro is double-digit up, various other high-yielding currencies, even some Asian currencies seem to be doing well. Commodity currencies definitely in the positive there. How would you look at the overall Forex volumes in this year until time? And where do you see more money flowing now as we move ahead from here?
That's a good question. So in a world where I believe we are in a phase of structural reallocation of global capital, that is, foreign investors looking to reduce their asset allocation in the US and looking at other parts of the world, where the diversification flows will go to will be important. I think there are, 2 potential flows that will happen. One is what I would term a bit of a repatriation or more of a homecoming type of flow. This will be largely from European and Japanese investors who will probably look to bring their flows back home. Hence, that will continue to strengthen the euro and the Japanese yen as well. And for the yen, which so far has been underperforming, I think once we get the Bank of Japan ready to engage in their hiking cycle again, I think that will definitely attract Japanese investors back home. Then you have other markets which have solid credit ratings that can benefit from diversification flows. That will include Australia, which is AAA rated, and Singapore, again, another AAA rated country, which has been attracting tremendous amounts of inflows, keeping the Sing dollar very strong. So I think the hunt for alternatives to the US dollar will continue, and those flows will benefit those currencies in particular.
You want to give us a level on either of those two, Australian dollar and Singapore dollar? You're factoring in more strength out there. So where do you think that one's headed?
So for the Aussie, it's already broken 65 cents. We think it could, carry on for another couple of cents before the end of the year. For the Sing dollar, it is constrained somewhat by the monetary policy, where the MAS manages monetary policy through the exchange rate. The exchange rate is already at the upper bound of the policy band. So Sing dollar will continue to track basically broad dollar weakness.
All right, just one more word, Khoon. In the past, we've spoken about the Indian rupee as well. That's been quite resilient. It went dancing away to around 88 odd, and then it's been resilient, holding at around that 86 odd mark. I'm not sure whether you're tracking it closely, but levels you're looking at on the Indian rupee, given that the RBI has gone ahead and cut a double bonanza is what they gave us of sorts in the last meeting. Your take?
We believe the Indian rupee will be resilient, but it will underperform some of the other Asian currencies, which we feel will be able to benefit further from dollar strength. At the end of the day, India still runs a trade deficit, which will somewhat hold back how far the Indian rupee can appreciate. And given that the RBI has a very large short forward book, we think any opportune time that they have to rebuild their FX reserves to accommodate the maturing of those FX forwards will also put a limit to how far the rupee can appreciate.
When you're talking currencies, you cannot but absolutely talk de-dollarization as well, Mr. Khoon. And we've seen that as a theme play out quite strongly, if I may say, this year. We have a BRICS meeting happening in Brazil in the first week of July. I mean, that is something that markets will keep an eye on in sense of statements there. But the way we have seen Forex reserves as also continue to see a decline when it comes to dollar there, you think this is a pattern that can continue in the coming years as well?
Most definitely, I would more or less term it as diversification away from the dollar rather than necessarily the dollarization. I'm a firm believer that the US dollar will remain the preeminent reserve currency for quite some time. But that doesn't mean that central banks will not want to reduce their allocation to the US dollar. We've seen that very clearly in the last couple of years in particular, as many central banks continue to increase their holdings of gold in their reserves. That's a part of diversification. And I believe that we will see further reduction in the exposure to the US dollar. And this is where the hunt for other high quality currencies that are AAA, and this is where Sing dollar and Aussie dollar, as I mentioned earlier, will probably get more of a look in as part of this shift to reduce the overall allocation of dollars in central bank reserves.
Khoon, we in India also watch out for this, the way the Chinese yuan moves really. You've talked about various other currencies, but when it comes to Asian currencies itself, it has been a volatile year in the first half, whether it has been about the Korean won or the Singapore dollar for that matter, Japanese yen, and of course the Chinese yuan. With so much happening within China in sense of data and the conversation of trade with US, and then of course expectations of more stimulus going forward, how would you look at currencies within Asia?
Well, I think that's going to be a fairly mixed bag. There are some idiosyncratic stories that are important, that are having specific impacts on currencies in the region. For the Chinese yuan, I'm anticipating probably more of a modest gradual appreciation on the back of dollar weakness. The People's Bank of China continues to manage the currency very closely. Now, they're willing to let the yuan benefit from dollar weakness by setting the fixings stronger, but on a very measured pace. So that means that while the yuan is gaining against the dollar, it's still underperforming against a basket of other currencies, such that the trade-weighted yuan basket is actually falling. And I think the authorities are quite happy with that, because that enables their exports to remain competitive and helping to offset some of that tariff impact. Now, the other currencies that you mentioned, such as the Korean won had a really tough time earlier in the year because of domestic political uncertainty. But following last year's presidential election, that political risk premium has now been removed. And we've seen the Korean won recover quite strongly, and I think it can make further inroads. I think the real big mover in Asia has been the Taiwan dollar, which appreciated at record pace in the month of May, and so far is still under appreciation pressure due to the Taiwan running record trade surpluses as front loading is benefiting their exports, plus the need for their Taiwanese insurance companies to hedge against further dollar weakness. So quite a few idiosyncratic factors that I play that are important in driving respective currencies that we need to watch.
Oh, there's a lot to watch as we go forward from here. Khoon, thank you so much for joining in today and appreciate your time. Well, interesting statements coming in from Khoon there that the dollar index, for one, could be looking at further declines. And we're not done yet in the first half. Second half could see further declines. And we're not done for 2025 because in 26 he expects the dollar index to decline all the way to 91 as well. And de-dollarization is for real. And he also spoke very interestingly about how a lot of home countries are bringing in their currencies back, increasing their reserves in various other currencies, not so much in dollar index. So that's a pattern that perhaps could continue as well. But then we are going for a very short break. On the other side, when we come back, we'll be joined by S&P Global's Premasish. Stay tuned. We'll talk all things crude on the other side. Welcome back. We're joined by Premasish. He's Executive Director for Oil Markets and Research and Analysis at S&P Global Commodity Insights. Premasish, hi, thank you for joining in. I want to get the numbers out of the way first. And we've been talking to a lot of people. The ranges that we are getting for the crude oil prices for this year, even the next, is anywhere between 55 to 75 to 65 to 85. What is your range for the crude prices for the near term?
Thanks, Manisha, for having me here. I mean, yes, indeed, actually, it's a very volatile market, and the price can vary a wide range, as you mentioned, actually. Obviously, depending on what kind of situation or the scenario you're putting in, I think the price could be very different. Like in our base case, I can tell you, like our price is essentially, we think the price will decline from the current level, and it will drop maybe to the below $60 or $55 level by end of December. So it's a significant drop, you can imagine. But at the same time, like if you think about, and that kind of situation is only possible when we think like, okay, all the risk premium, whatever we are seeing, or we have seen for last few weeks, is kind of disappeared. And eventually, the market goes back to the fundamental basis. But the fact is that is a kind of one way of looking at it. But the situation is, if you think about Iran and Israel, what happened, I think outcome could be like there could be more challenges going forward. I mean, obviously a ceasefire is done, but whether the ceasefire will sustain for a period, I think that's a question mark, right? We don't know. So if there is, we see more volatility or more tensions there, the price can stay up to $70, $75 easily the rest of the year. Or think about a situation like it really escalates again and another exchange happens, and maybe that impacts like Iranian supply to some extent. The oil price can go up to maybe $85 plus. I mean, yeah. And so you can imagine like all possible options. But for us, I mean, we see it goes back to like the fear will disappear and diminish for sure. And we expect market will fall back to more to fundamentals, and then the oil price will drop to maybe below $60 to $55 to $60 in band by end of the year.
All right. Hi, Mr. Das. Good to see you in. Nigel on this side. A quick question with regard to the year end now. As you're suggesting that if we go back to fundamentals, crude oil prices could slip a little bit. One important factor is going to be what OPEC does next. In the near term, the next meeting, what kind of production hike are you working with?
Yeah, I think you're right, actually. I think the biggest thing in the market right now is obviously one part is demand slowing down because of all the tariff impacts and other stuff. But the bigger story is supply. The supply from particularly OPEC Plus, we are expecting it to increase. I mean, we have seen few rounds of increase, and we think it will continue actually and we think in our base case we assume that maybe by end of October, up to October level, OPEC Plus will complete their rollback activity, which is that they are going back to the 2.5 million barrels increase what they wanted to do since last year. So with that, you can expect the oil supply in the market will be significantly higher. The inventories will build. But of course, there will be another factor there which can compensate and offset to some extent, which is how the US producers are going to respond here. Although we are not expecting a very immediate response from them, obviously it takes a bit of time. But that will essentially dictate the positioning of the market. But going forward, in the end of the year, we do see, particularly the second half of the year, we do see a very oversupplied market globally for oil market, crude oil.
Mr. Das, I would want to understand, with the kind of volatile and various case scenarios that we are working with, for a country like India, which imports almost 90% of its oil requirements, what really are the implications then, and what strategies would you believe that the authorities should hold here?
Yeah, I think that's a very good question, Manisha, to be honest. 90% import dependency is something very challenging. So the fact is, if the oil price, there are two aspects, I think I would say. There are two challenges there. One part of it, obviously, is the oil price itself. If the oil price stays at a high level, that's definitely not a good thing for any economy like India, who is pretty much dependent on oil imports there. But the second part of the story is that, as you mentioned, is the diversification, like where from the oil will be coming and what kind of disruption that can cause the changes in the trade flow. I think if you look into current situation, India is almost 30% or 30 to 40% level at times are importing from Russia, which is discounted barrels. So in a way, right now it sounds good, but on a long term or even medium term, that could be challenging, depending on what US and Russia, they kind of come up with a deal, or maybe how Europe is involved in this process. I think that number could be a challenge. So India really need to look for more diversification of sources. For India, I think the most strategic location is Middle East, and if they look at the crude and the quality and then how the refineries are designed here, are kind of matches pretty well. So in Middle East, crude will be extremely important here. I think we cannot think of a strategy without Middle East here. So that is one of the areas need to look at. But at the same time, we all know that I think India is trying to import a lot more from the US. That is another area where we can get more oil there. But obviously, it may or may not be as cheap as any other sources, right? So that is another challenge there. So essentially, and then rest of the things are coming from the Africa or even Latin America. Those are the crudes are also would be available and would be used. But the key question also here is the cost, right?
Right.
What is the best? Refiners run based on their cost optimization. What is best? They will use it in terms of cost and obviously profitability. And refining business is not likely to do fantastic in going forward as the second half to even the later part of the, next year. So with that, I think there will be a significant cost pressure for them. So that is the way they need to manage. I think need to diversify definitely. But again, I think we need to consider Middle East as a source here as a base to manage the situation.
We get that. Premasish, one interesting thing, this is something that we keep saying all the time, that crude oil is 80% geopolitics, it's 80% politics, and 20% perhaps is what demand, supply, and price move is. But at this point in time, from where we stand, and with just so many factors into play right now, what would you say is, or how much is the speculative activity that you're looking at in crude oil prices currently?
Yeah, definitely geopolitics is extremely important for oil, but we are at a world, Manisha, I just want to highlight that we are at an era of surplus. So we have so much supply available compared to how much demand growth is happening. So with that, impact of geopolitics will be a lot more less compared to others. Think about the scenario what happened 2-3 weeks back, like Iran-Israel exchange happened. I mean, in other times, you think about the oil price can shoot up to $130, $40 perhaps. What did not happen? Why? Actually, because the market has so much supply compared relative to demand. So there is no real chance for the geopolitics to take a upper hand on the whole process. But geopolitics is extremely important. We have seen the prices gone up. But fundamentals here is kind of helping the situation, particularly to kind of ease that big uncertainties into the market.
So Premasish, in a market like where you have huge surpluses and we're looking at further decline in prices if all things are fine, would you say producer hedgings would be at near all-time high at these current levels then?
Sorry, means you're saying the oil price or
the hedging,
I missed the question,
producers, hedgers.
Oh, yeah, producers definitely will try to hedge. I mean, for sure, that is one of the key things they would try to do it. But again, the question is, the market is when it is a significant amount of uncertainty there, so that hedging is also a kind of a challenge there. But hedging will happen for sure, particularly if you think about US producers, they would do hedging. But given the uncertainty to the market, I think that also creates somewhat a bit of uncertainty for that activity as well.
Oh, absolutely. Uncertainty perhaps is the name of the game. But interestingly, as Nigel, we keep talking about to so many people, and where do you think crude prices are going? 55, 85, 95?
I'm hoping just the price that I pay for crude comes down. But yeah, but it appears from all the feedback that we got, I don't see a call where we move to $80 per barrel plus. You know, I mean, it should have been the case last week, but that didn't happen. So I'm betting on maybe staying in a bit of a band. Well, I guess on that note, though, we'll wrap up on this edition of Big C. That's it from Manisha and myself. Stay tuned. More news and updates coming up on the other side.